Insurance advisor. This video here is all about ACC. What is it? How does it work? Now, people ask me, what are you doing talking about ACC, Mike? Well, it's because ACC is an insurance that you pay for. PAYE earners pay it through their payslips. They will see it just under their tax or their KiwiSaver. And also self-employed people pay it. As soon as they declare an income, they will get an invoice once a year, and it often comes as a surprise, but they know they've got to pay it. So if you're self-employed, definitely watch this video. I'm going to be talking about you guys in this video. Or if you've got an insurance policy, it's really good to understand how your insurance policy performs if you're getting ACC compensation. But regardless, this video will talk to you about ACC. So what do you get for your levies that you pay for? So what you get is three things, and that is a type of health insurance. So how it works is ACC is there to assist you with medical costs if you have an accident. Now, let's take a typical scenario. Let's just say you fall over and twist your ankle and you go to a physio. What happens is ACC will compensate the physiotherapist to provide that service to you. It's over to the physio whether they want to charge you a little bit more, and it's over to you to understand if the physio is going to charge you a little bit more. But rest assured, a large portion of that is actually paid for by ACC. Life insurance, if you die from an accident, then ACC pay those that need to be compensated because of that loss of income. It's a wider conversation. Happy to have it with you. Income compensation is largely what I'm going to focus on in these couple of slides. So your levies basically help insure you for to pay 80% of, for ACC to pay 80% of your income, your declared income, if you can't do your occupation. There is a stand down over 7 days, but if you're out of work for over 14, then they will actually pay that second 7 days to you. And it's 80% of your declared income. Now remember, that's for accidents only. Understand though that there is a cap and there's a minimum, max and minimum. So if you're on $400,000, don't think that ACC are going to pay you for 80% of that. It ain't happening. It's going to cap out for this financial year, 2014 to 2024, 2025. The maximum you'll ever get is $113,826, and that is gross. So they take the tax off you, excuse me, before they pay you. The minimum amount of insurance that they pay is $35,400, and that is for people that are working full time. Now this is a scheme called Cover Plus, and it is the default scheme that everybody goes on to. However, there is another scheme that you can actually apply for called Cover Plus Extra. Now, for those that are self-employed, this is really interesting. So let's just say you just started out in business and you decided you're not going to be on PAYE, so you're not going to put yourself on a salary, but what you're going to do and pay your taxes as you go, what you're going to do is you're going to do a wash up at the end of the financial year, give your figures to the accountant, and the accountant tells IRD what you've earned. Now, if you say 6 months into your being self-employed, you're earning say 150,000, and you have an accident. Now, what's happened is you're not declaring any income. You haven't declared any income. You're not going to declare any income until you do your tax return, which could be in another 6-8 months' time. So from an ACC perspective, there's nothing to compensate because you're not declaring any income. So this is really, really important to understand. If you're self-employed and you've just started out, and you're not on PAYE, which is Cover Plus, then what's happening is there's nothing to compensate. So you are financially exposed. So you either take private income insurance to help you out, or you talk to an advisor to go on to Cover Plus Extra. So I'll get onto that in a couple of slides. So just understand that if you're new to business, then talk to an advisor about your cover and get them to talk to you about how ACC works in that period of time when you have not declared an income. So Cover Plus, the default scheme that everybody goes on to. So let's just say you're earning $100,000. You go down for an accident. The GP says, okay, you can't work for a month. Then ACC will give you that 7-day period, and then they'll start paying you 80% of your income. Sometimes they pay it to your employer, and the employer chooses to top that up. It all depends what sort of relationship your employer's got with ACC. But generally, you'll get paid 80% of your income that you've been declaring. The key thing to understand is that's fixed. That is what it is, and your levies are based on that. But as you return back to work, as your GP issues you with doctor's certificates saying that you can go back to work 3 hours, 4 hours, 5 hours a week, then ACC start paying you less. They abate you, and it's really important to understand that. And the reason why they abate you is because you're probably going back to work, and you're probably getting paid anyway. If you're self-employed, let's just say you're a real estate agent, then you're going back to work. You might be on commission only. You're not necessarily getting paid, but you're technically going back to work, and they're abating you. So you could be out of pocket. So this is where you've really got to understand how ACC works. And part of the frustration with ACC is people don't actually understand how it actually works. If they knew how it works, then they would understand it and not be so frustrated. But frustration particularly comes from self-employed people. So self-employed people, Cover Plus Extra. So you're the only type of people that can go on to Cover Plus Extra. And so the qualifications that you've got to be self-employed, and you've also got to be not declaring your income on a regular basis. So i.e. you're not on PAYE, paying yourself and paying tax, once a fortnight, once a month. So if you're not paying yourself, if you're taking a shareholder's salary or drawings and you're doing your tax once a year and declaring once a year, then you can choose to go on Cover Plus Extra, which is the best scheme, hands down. Okay, happy to debate that. It does cost you a little bit more, but it's actually not that much. Works out roughly about $100 a year to go on to Cover Plus Extra. But look at the benefits. So A, there are no abatements. So what happens is as you return back to work, ACC still keep paying you the full amount of compensation. So it's really good. So until such time as you're back to work 6 hours a week or 6 hours a day, 30 hours a week, then your Cover Plus Extra stops. The other really good thing about Cover Plus Extra is that you can choose how much you want to be insured for. So let's just go back to that scenario when you're newly self-employed. You can actually go back to ACC and fix a level of cover with them. You don't have to take the minimum. ACC have got an occupation list of, let's just say you're a plumber. They know how much to insure a plumber for. So there is certain rules around that. But if you've already declared an income, then they will have a baseline as to what you're earning. So you typically can't go over that. But what you can do is you can choose a level of cover that suits you. Some people choose to drop it right down to the minimum, which results in you saving a lot of money on ACC levies, particularly if you're a builder or you've got an occupation which is hands-on or high risk. You do save money, but your insurance drops. So you don't do that on your own. Talk to an advisor about the implications of that. I stress. Some people choose to take that savings and put that savings into private income insurance that covers you for illnesses and accidents. But that's, once again, it's a conversation you have to have with an insurance advisor. Let's have a look at the differences between the two types of cover. So you don't have to fix it for the minimum. You can go high, you can go low, but you can choose. So the other two benefits, you can choose, and then also what you can do is you can actually, you don't get abatements. Now, private income insurance, what's the difference between ACC and private income insurance? So ACC's job is to get you back to any occupation. So they don't care what you're earning, it's about hours worked, okay? And it's accidents only. Private income insurance is more about your own occupation or earning the amount of money that you were earning before, okay? The hours worked also sort of comes into it, but it's more so about the amount of money that you're earning. And it also insures you for accidents and illness. So let's have a look here. This is really important to understand. If you've got private insurance at the moment, let's just say your private insurance kicks in after 30 days and ACC is still paying you after 30 days. In most cases, ACC will actually offset that cover. So your private insurance won't pay while ACC pays. And that's really important to understand because it can be a very big frustration because you think, oh, great, I'm going to get double the money. Well, in most cases, you don't. So it's really important that you talk to an insurance advisor like me to actually either understand it or get insurance that pays out on top of ACC. It can be done. Talk to an insurance advisor. Talk to someone like myself go to my website, theinsuranceadvisor.co.nz, hit inquire now, and fill out the form and get in touch, and let's have a chat so you can understand how ACC works for you. Catch you later.